this week's market update, interest rate fears continue to spook bonds and equities, earnings season looms, and the G20 sets the tone for a nervous summer. Markets, and bond markets in particular, have endured a tough couple of weeks since Mario Draghi and Mark Carney triggered Europe's 27 version of America's 2013 taper tantrum. Softening up investors for rate rises to come has had a similar impact to Ben Bernanke's tentative warning 4 years ago that US monetary easing could not continue indefinitely. Investors have become hooked on cheap money since rates were slashed in the wake of the financial crisis. The prospect of higher rates and the withdrawal of central banks' huge bond buying programs, quantitative easing, retains the power to rattle investor sentiment. Doesn't take much. Neither Draghi nor Carney promised tightening, they just said it was possible. German 10-year bond yields now stand at an 18-month high. Although the income on offer from these medium-term bunds is still a pitiful 0.56%, that's still more than twice the level before the central bankers spoke in Portugal a fortnight ago. Since June the 26th, German bond yields have risen by 0.31%. In the UK, the 10-year gilt yield has risen from 1.01% to 1.31% over the same period. Even over the Atlantic in the US, where the bond market has had considerably longer to get used to the prospect of higher rates, 10-year Treasury yields have risen in 7 of the past 8 trading sessions to 2.39%. That's the highest level since mid-May. In Japan too, yields are nudging higher to more than 0.1%. Now, that might not sound very high, but the Bank of Japan has pledged to keep bond yields at close to zero, and last week it offered to buy bonds in an unlimited amount to cap the upward trend. Is this a problem? Well, arguably not, because the reason why the markets expect interest rates and bond yields to rise from here is the prospect of economic recovery. That's a good thing. The bad news is that with the global economy still saddled with historically high levels of debts, any further rise in the cost of borrowing obviously leaves less for other purposes, whether that's government spending or company profits and dividends, or indeed consumer spending. This two-way pull between recovery and higher funding costs is why investors watch central banks so closely, and why they analyse every bit of data that might in turn shape the future path of interest rates. The latest of these came on Friday last week, when the non-farm payrolls data emerged stronger than expected. Payroll growth of 222,000 jobs was an improvement on the previous month's upwardly revised 152,000, and easily beat expectations. The good news for markets, and why they enjoyed a better end to the week, was the fact that this robust jobs growth is not yet feeding into a meaningful uptick in earnings growth. Wages were up by just 0.2% on the month and 2.5% year on year. So that combination of decent jobs growth but an absence of wage inflation should help the Federal Reserve justify its current gradual path to monetary normalisation. If the economic and financial outlook ended the week on a more upbeat note, the same could not be said of the political backdrop. The week started badly after North Korea chose America's Independence Day holiday as the most provocative time possible to launch an intercontinental missile test. North Korea's increasingly confrontational approach is raising the geopolitical stakes in Asia, and it's driving a wedge between the US and China, which President Trump accuses of failing to rein in its small but dangerous neighbour. If Trump is short of friends in Asia, he's not exactly flavour of the month in Europe either. The weekend's get-together of the G20 leaders in Hamburg was the frostiest gathering in years, as the rest of the world lined up to criticise the US's positions on global trade and climate change. The US president finds himself isolated as the rest of the world reacts with disdain to his America First policies. One area where America does tend to be first is in the publication of financial results, with second quarter earnings season due to kick off this Friday with a string of mainly financial results. JP Morgan Chase, Wells Fargo and Citigroup are all due to announce profits for the 3 months to end of June. Other non-financial companies to be quick out of the blocks this week include PepsiCo and Delta Airlines. Attention is focused on earnings season for a couple of reasons. First, because with share prices starting to roll over as the Trump trade fades, the pressure is on for company profits to continue growing. Only if earnings keep rising can America's relatively high valuations be justified. Second, investors will be perusing results to decide whether the second quarter sector rotation from high growth but expensive technology stocks to less exciting but cheaper financials has further to run. Technology was the hot sector at the beginning of the year as investors saw it as a reliable source of growth in a low growth, low interest rate world. More recently, however, financials have picked up the baton as they stand to gain more from rising interest rates. Now, before we get to earnings season, we should get some insight into the Federal Reserve's latest thinking on those interest rates, as Janet Yellen delivers her half-yearly testimony to Congress. She's speaking to the House of Representatives on Wednesday and then the Senate on Thursday. Last week's minutes of the latest rate-setting meeting showed that the Fed is looking to press ahead with both raising rates and unwinding its $4.5 trillion balance sheet. After the June meeting, Ms. Yellen struck a pretty hawkish tone, particularly with regard to inflation, which she clearly sees as a growing risk. In particular, she thinks that the current rate of job creation is more than enough to absorb new entrants into the labour market. So for her, wage inflation must only be a matter of time. As well as the Fed chair's testimony this week, there's quite a bit of US economic data to keep an eye on. In light of the absence of wage inflation, producer prices data on Thursday will be worth watching, followed by consumer price data on Friday. Both are pretty tepid at the moment, with core inflation expected to rise 0.1% month-on-month in June after a 0.1% fall in May. This week, we also have retail sales and consumer credit data, and on Friday, industrial production figures. So, all in all, by the end of the week, we should have a much clearer view of what's going on in the world's biggest economy. And finally, Brexit Watch. Attention this week is on the publication on Thursday of the repeal bill, which will replace European law in the UK. With Theresa May's government only able to secure a majority with the support of Northern Ireland's DUP, we can expect a rocky ride for the legislation when it's debated after the summer recess. A whole string of amendments is likely, and the government will be forced into making many compromises along the way. The even bigger question, once politicians return after the summer break, will be how long the Prime Minister can hang on to her job, with many speculating that she'll struggle to reach the autumn conference season.